Welcome to Smart Wealth with Joshua, and Merry Christmas to you.
Your daily stock analysis and catalyst talk. Today we're looking at Ascent Solar Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
All right, so let's get into it. This is a really fascinating one today because we're looking at a company that's, it's a real paradox.
A paradox. How so?
Well, you have this absolutely phenomenal, really unique technology, but it's been stuck inside a, let's say, very challenging financial structure for a while.
Okay, and we're talking about Ascent Solar Technologies. I think a lot of people hear solar and they just tune out another panel company.
Exactly, but that's the first mistake.
Yeah.
If you think this is just another solar panel manufacturer, you really need to recalibrate your assumptions. This is a different beast entirely.
Right, so this is not your big utility scale solar farm stuff. It's a hyper-specialized technology innovator. So what do they actually make? What's the core asset here?
Their core identity, their whole moat, really, it rests on one proprietary asset.
Which is?
It's their flexible, thin film CIGS solar technology.
CIGS, okay.
CIGS stands for copper indium gallium selenide. It's an advanced semiconductor material that just completely redefines what a solar panel can even be.
So the key here isn't just generating power, it's how it's built.
Precisely. The key feature is the flexibility combined with an extreme weight reduction.
Can you elaborate on the weight? Because I think that's the central point, right? That's what separates them from the big players like First Solar or SunPower.
Absolutely.
Yeah.
So your traditional rigid silicon panels, the big glass things you see everywhere, they are heavy and totally inflexible.
Sure.
Ascent's thin film panels weigh only about 3% of what those traditional panels weigh.
Wait, say that again? 3%.
3%. Think of it less like a window and more like a durable, flexible sheet of plastic that can conform to almost any shape.
That is an unbelievable difference. And that's where it gets interesting for an investor, because that kind of weight saving, it completely changes the use case. They're not competing for space on my roof, are they?
No, not at all. And that's the strategic pivot the company is finally committed to. They're explicitly going after high-value niches where rigidity and weight are the absolute deal breakers.
So they tried the residential game and it didn't work out.
Couldn't compete. The production costs, especially against China, were just too high. So now they sell a tailored solution to clients who need that performance and, crucially, can pay a premium for it.
Okay, so what does that client list look like? I mean, who actually needs solar power that is 97% lighter?
It's mostly dominated by three sectors: space, aerospace, and defense.
Makes sense.
Imagine a high-altitude drone, a UAV, that needs to stay in the air for weeks, maybe even months.
Right.
Every single ounce you save translates directly into more flight time or more payload. It's an exponential gain.
Yeah.
The same exact logic applies to satellites.
And I'd imagine for space, it's not just about weight. What about the harsh environment, like radiation?
It is a factor.
Sure.
Thin film tech often has better radiation tolerance than crystalline silicon.
Yep.
Plus, think about deploying a normal solar panel in space. It's a big, stiff wing that needs heavy, complex mechanisms.
A lot of points of failure.
A ton. Ascent's technology can be rolled up or even integrated directly into the skin of the spacecraft. It cuts down on mass, complexity, and that IP, that process, is their primary moat.
So that creates really high switching costs. If a big defense contractor designs a satellite around this film, it's not like they can just swap it out for something else later.
They're locked in.
Yeah.
And we're already seeing this happen. This isn't just a science project anymore. We're tracking specific partnerships with Cislunar Industries for the moon and also Defiant Space.
So these are real-world applications, not just press releases.
These are tangible, high-profile projects. It's fueling real optimism in this very specialized, high-margin market.
Okay, so that's the good news. The technology is a potential golden egg, but now we have to pour some cold water on this. Let's look at the financial reality, because the balance sheet has been, well, pretty weak.
That is the elephant in the room. The tech is proven, but the commercial execution risk is huge. Historically, they've really struggled to turn that technical brilliance into actual revenue.
And the numbers show it. Revenue is still minimal. We're talking low single-digit millions, which has been the case for a while.
Right, which is somewhat typical for a company in this R&D heavy phase, but, you know, it doesn't pay the bills.
And with low revenue comes the downstream consequence. I mean, the profit margins are deeply, deeply negative.
They are. You've got high operating expenses from R&D, from building out the production lines. It all leads to significant cash burn, consistently negative free cash flow.
So every dollar is going right back into the business. No buybacks, no dividends.
Not a chance. This is a capital-intensive turnaround play, plain and simple.
And the market has punished them for it. The stock performance year to date is brutal, down something like 41%. That's not just noise, that's the market pricing in that massive execution risk.
It is. It's the risk of trying to scale a very specialized manufacturing process for the most demanding clients on Earth.
So the core risk here has always been capital failure, right? That they'd just run out of money before they could get to scale.
Exactly. A lot of innovative tech startups die on that hill. It's not that the tech is bad, it's that the money runs out. That 41% drop was fear. Fear that they wouldn't get the cash to get over the hump.
That context is so important because it leads us directly to the major catalyst, the thing that just changed the entire story.
The capital infusion.
This wasn't just another financing round. This was a lifeline designed specifically to solve that cash burn problem.
It provides the runway. They secured a capital raise, a private placement, for a potential total of $5.5 million. This deal basically shifts the story from, will they survive, to, okay, can they execute?
Let's break down that structure, because how these deals are built really matters for investors.
It was very strategically designed. So they got $2 million of upfront funding immediately. That was at a price of $1.95 per share.
Okay, cash in the door.
Cash in the door. But the other $3.5 million is structured as warrants, Series B warrants, that investors can exercise later on.
So the $2 million stabilizes things now. But that extra $3.5 million, that's the real leverage. It only comes in if the stock performs, which signals confidence.
You've got it. The upfront cash pays for working capital, keeps the lights on. It takes that immediate risk of financial distress off the table. But the warrant money, that's tied to a validation event.
And what was the market's first reaction? Usually, issuing new shares means short-term pain.
And it did. The placement involved over 1 million new shares, so the stock dropped about 15.5% right after the announcement. The market priced in that dilution instantly.
Which is totally normal for this kind of raise.
Completely. You take the short-term dip for the long-term ability to execute.
And let's not forget the institutional signal here. H.C. Wainwright was the placement agent. That's a name that carries some weight in these kinds of deals.
It does. Their involvement suggests that serious institutional money is watching this. They wouldn't structure a deal with warrants unless they saw a clear path for those warrants to become profitable.
Meaning the stock price has to go up. They're betting on the turnaround.
They're essentially betting on Ascent securing and executing on those big contracts we talked about.
Okay, that makes perfect sense. Let's connect that financial structure to what we're seeing on the price chart. Stock's been all over the place, but this dip after the placement, it feels like we're in an accumulation phase. Where's the floor?
Well, analysts are pointing to a key support level, and it lines up perfectly with the financing terms. We're seeing strong support identified right around $1.70.
And why is that 170 number so important? Is it just a technical level?
It's more than that. It's highly correlated to the warrant exercise price. That 170 level is where those big investors feel comfortable accumulating more to maximize their return when they exercise those warrants.
So for our listeners, that 170 price acts as a kind of structural floor. The big money has an incentive to defend that level.
Exactly. If it drops much below that, the mechanics of their deals start to look less attractive, so they're likely to step in.
A fascinating dynamic. Now, looking at momentum, we haven't seen that big technical signal yet, the golden cross, where the 50-day moving average goes above the 200-day.
No, not yet. We're still in the pre-catalyst phase.
Yeah.
But the RSI, the Relative Strength Index, is pretty neutral after that sell-off.
Yeah.
What analysts are watching for is a volume spike on some real space mission news.
And that could set up what?
It could set up what's called a hidden bullish divergence.
Okay, for listeners who don't track every indicator, what does that mean in simple terms?
It basically means the stock price might be moving sideways, or even down a bit, which looks weak. But underneath, the momentum indicators are quietly starting to tick higher.
So sellers are losing steam, and buyers are quietly moving in.
Exactly. It suggests momentum is building under the surface, setting the stage for a really strong move up when the good news finally hits.
And what is the news we're waiting for? There's been some unconfirmed chatter out there, right? Whispers about NASA or defense contracts being tied to those warrants getting exercised.
That's the potential virtuous cycle. Let's say a major defense contract gets announced. The stock jumps because the market sees validation,
And that price jump pushes it above the warrant exercise price.
which then triggers the investors to put in that remaining $3.5 million. That fresh cash then de-risks the next production ramp, allowing them to take on even bigger contracts.
It's a flywheel effect. The contract causes the price jump, which unlocks the cash, which funds the next bigger contract.
You've got it.
So let's lay out the catalyst calendar. If you're thinking of this as a swing trade into early 2026, what needs to happen?
You have to watch the next few quarters very closely. The big validation point is really Q1 2026. The Q4 2025 earnings will come out late February or March 2026.
And what's the market expecting then?
Consensus is for flat revenue, which isn't the main story. The market is really looking at the balance sheet, the positive impact of the placement on their liquidity, their ability to actually scale.
So don't look for a revenue surprise. Look for updates on production capacity and a stable cash position. What are the specific event triggers to monitor?
Two main things. First, any news about those Series B warrants being exercised. If that $3.5 million comes in, that's a huge confirmation signal.
And second,
We need real, substantive updates on those space missions with partners like Syslin. Mission milestones, that's what proves the pivot is working.
and of course, they're riding some powerful macro tailwinds right now. They're right in the sweet spot of global investment priorities.
Absolutely. There's a big sector rotation into specialized renewables and space tech, and with defense budgets rising globally, there's a huge push for lightweight, efficient power for next-gen military assets. They're perfectly positioned for that.
Okay, so let's put it all together. We've got proprietary tech, a history of financial weakness, a critical cash infusion, and a whole lot of execution risk tied to these upcoming catalysts. What's the final investment thesis here?
The thesis is pretty straightforward. This is a high-risk, high-reward turnaround story. It's built on a proprietary moat that solves a critical problem for the exploding space and defense sectors. And that recent funding just supercharged their ability to actually get it done.
So the practical takeaway for you, the listener, is this. The opportunity is framed as a chance to buy the dip, positioning yourself near that technical floor around 170. You're buying a potential for a 2 or 3x gain as these panels start powering real missions and that extra cash gets unlocked. It's a bet on execution.
And if we zoom out, the bigger picture is that the aerospace industry is moving away from heavy, old-school power sources. It's inevitable. Lightweight, conformable power is a non-negotiable requirement for the future. The only question for Ascent Solar is whether they can finally execute now that they have the runway to meet that demand. Thank you for joining us for this analysis. Remember to subscribe to Smart Wealth with Joshua for continued analysis of market movers and catalysts.